Where are stocks going in 2023? The first thing I'm going to say to you is if anyone tries to act like they know where anything is going in the short run, you need to avoid them like the plague. However, what I'm going to do in this video is show where we stand today based on history and market valuations and what that means for the future. It can mean a number of things for next year. We don't know exactly where the stock market's going to go. However, we can sit there and say, based on, Mo's going to look at the charts. He's going to sit there and say, here's the momentum. Here's what you want to see. Here's what could happen if certain things do happen. But for us to sit there and say, this is where stocks are going to go, it's a fool's, it's not a fool's errand. It's a fool's search. I don't know what the thing is.
You're just a fool.
You're just a fool if you try to sit there and say that. Whenever I hear somebody say, well, yeah, in the early part of this year, rates are going to go, blah, blah, blah. Shut up. And you have to avoid those people.
Yeah, the funny part is you talk to analysts, they say one thing. You talk to legitimate people that get to vote for the Fed interest rate hikes, decreases, whatever. They say something totally different. Who knows?
We don't have a clue. But my job as a value investor is to see where we stand today based on valuations. And I've created my own stock market to GDP ratio. Why is that important? Well, Warren Buffett, who I'm sure you've heard of, who everyone would argue is 99 out of 100 people would argue is the best investor of all time. That is not an official survey, by the way. He thinks the stock market to GDP ratio is the single most reliable metric at any given time on where stock market valuations currently stand. Okay. So let me pull that up first. What I did here was I went back to 1929. This is as of yesterday's close in the S&P. And I tracked the GDP to the S&P. Now, the S&P is a market cap based index, right? Yep. So it allows me to just take the S&P and do some division, blah, blah, blah. We are currently at GDP at the end of September of $25.7 trillion. And as of yesterday, the S&P was at 3998.84, which makes the ratio 1.558 and overvaluation of 67.7%. That means the market is currently 67.7% above the historical average metric. Okay. Now, what does that mean? Well, in the typical 10-year return, not including dividends, the return is 6.6%. Makes sense because average dividend yield historically has been about 3.5%.
Yeah, and it puts you right at 9.9.
Pretty close to it. Now, historically, recently it's been a lot lower. Now, when we're undervalued, the average is 9.3%, not including dividends, return over the next 10 years. When we're overvalued, 2.3. Now, here's the scary part. In history, when we've been 30% or more overvalued from historical average, the return is negative 0.1%. We're at 67.7, over double this number. So what does that say for the future? It's probably gonna be a rough road because two things can make us go back to even. It's market cap divided by GDP. How do you make this number go down? You either decrease this a ton or increase this a ton. What's easier? The stock market to plummet in value or GDP to go up a ton?
Stock market.
Yes. Now, it'll probably be a combination of both. But again, I have no idea what that means. Now, if you're watching our channel, you probably about 70% of our viewers fall between the ages of 25 and 45 years old. I'm 41, most 33, so we're on the low and high end of that range. If you're my age, you've lived to see the dot-com bubble, right? And since then, the stock market has not done very well. Right. You lived through the 2008 financial crisis. Mo, what did you live through?
COVID.
That's it.
And that lasted 3 weeks? 6 weeks?
4.
4 weeks?
It went from peak to bottom to back up to the same point in 6 months.
Okay.
So you haven't experienced
much.
You haven't experienced bad years. Yeah. In fact, back-to-back losses, and it's only happened. The last time it happened was 2001, 2002. Yeah. Ironically, that was the last time Michigan beat Ohio State back-to-back years. Isn't that weird?
Coupled with the Phillies thing, this market's going down, baby.
No, the Phillies, when they won, they had to win in order to have...
So we're going to just keep going up.
So you're probably thinking, well, markets don't go down 2 years in a row.
Yeah.
They don't go down 2 years in a row.
Yeah.
I know the experience has not been the market going down. Right. However, I don't know what's going to happen in 2023. But what I do feel is going to happen based on this metric is that the next 10 years is going to be very difficult to make money. In what fashion? I have no idea. But all I know is that the market, you should look at the stock market as the GDP going up. But here's what the stock market actually does. This is value. This is the stock market. We're probably somewhere, my guess, over here. Does that mean you can't make money? No. It means you can still make money. But here's how you make money. whether you're buying a long-term ETF or good value-based stocks that are still going to fall. If stocks are going to be even over a 10-year period, if you dollar cost average all the way down and then back up, you've averaged paying this and you still make money in the long run. That's the key to all of this. So it is nice to have some understanding of where we are in terms of a long term. So Howard Marks, a great investor, 07, 08, he was saying things are bad. Before the market crashed, he's like, things are getting too frothy. And he avoided a lot of debt. Now, he said in a recent podcast, guys, I didn't understand how bad the CDO market was. I didn't understand how bad subprime was. Right. I didn't need to. What I need to understand was, in order for products like this to happen, things have to be very frothy. Things have to be very easy to borrow money. And that's what was happening. And I realized, whoa, you don't need to understand why things are crazy. You just see other signs of it. When I sit there and see people talking about how, we're fine, we're good, everything's back to normal. When I see people thinking that you buy stocks so they only go up. When I see people talking about how Warren Buffett is a moron and compare his returns over short periods of time to the market and to your neighbor's pimply 18-year-old kid.
People like Cathie Wood.
And when I see Cathie Wood, these are the issues. One of the things we love about our group chat is it allows me to get a feel for.
We have about 10 people in the group chat. It's a pretty good gauge of where things are sitting.
Yeah.
And they're in all different parts of industries.
Mo, give your Tesla anecdote.
Oh, so I decided to sell puts on Tesla at some point at $50.
What's a put on Tesla?
So what it is it's giving me the option to buy Tesla at a lower price. So let me pull this up. So right around here, let's say Tesla's sitting at $250 a share. I'm saying, well, I'm going to look out and go to February of 2022. Somewhere around here is when I want to go and buy Tesla. And if it gets down to $50 because I sold a put option on it, I'm going to be assigned those shares at 50. If I don't get them, if the stock price is not at 50, option expires, no issue. But I want to get the shares.
But you keep the money they paid you.
I keep the premium that I collected on the way. They literally laughed at me for saying that $50 was going to happen on Tesla.
Literally laughed at him.
They're the same people that if I would have done it, let's say I put a put today, what's the current price? 170, 180. Today's 180. If I would have sold a put when this thing was at $400 a share at 180, they would have called me stupid. They would have said there's zero chance that this thing falls to $180 a share. So that gives me a really good gauge of where we are. When people that think that they're really good at investing tell me that they're really good at investing.
But they react short term.
And that's all they look for.
That's it. And
all they look for is short term.
And guys, it has to be hard to make money. Making money can't be easy because markets can't go up forever.
I don't know if you said this or something, but
probably.
When
was it brilliant?
It was pretty brilliant.
Oh, then probably was me.
It was either you or Buffett.
Yeah.
So I'm just going to say you. Imagine if everybody was the best at your job.
Yeah, that's what I said it.
Okay.
Imagine whatever job you do, everybody in the world with no experience and no understanding just walked in and said, I'm the best at I'm great at this.
Imagine you're an engineer and everybody in the world was the best at your job.
Forget about that.
Imagine
you worked at a cashier at McDonald's and somebody just walked in and just started ordering stuff for people. Even that takes some training.
Yeah.
And even that takes understanding.
Maybe that's not where we are anymore in the market, but that's where we were in.
No, we still are there.
But it was really bad in 2020. 2021.
To me, it's not much worse today because it's not much better today because I look at it going, people still think, okay, we had to have a slowdown. 15%, that's not a slowdown.
Yeah.
15% is nothing.
Yeah.
We went 12 years at a 10% drop, like two 10% drops. You know what I mean? I'm looking at going, when we fell 40% and rebounded within 5 months, from peak to bottom to peak took 6 months. So from peak to bottom took 1 month. From the bottom to the peak again, back to the even was 5 months later. It just told me where we were. Now, what does that mean for 2023? I don't know.
Who knows? Who cares?
Who cares? What your job is to sit there and value companies, determine a price you want to buy. Look at my watch list. How many stocks do you have on your watch list, Mo?
Let me check.
I bet you I win.
I know. Oh, you definitely have more than me.
57. Child's play.
But you had so many that I don't agree with.
I have 110. What do you mean you don't agree with? You don't want to own them?
Like, what was the one today you did?
What do you mean? Lululemon?
No, it was T-Row and the one we did right before T-Row.
Yeah. T-Row and
AutoNation.
AutoNation.
Yeah, I was like, yeah, I'm out.
Oh, okay. Yeah. But T-Row, you're out on T-Row?
No, I'm not out on T-Row.
I was going to say.
I was trying to think which one is before T-Row.
Oh, gotcha. So I have 110 stocks on my watch list, and my job is to be patient. And all these numbers that I want to buy them at, they're not prices I want to buy them at. The prices for me to start selling puts at lower prices because I want to make sure that I go back in reevaluate, make sure my thesis is still the same, and then start selling puts at a lower price.
Yeah. Somebody said to me, actually in the EM community, they said, Mo, what's your 3 stocks that you want to own in 2023? I said, I don't care if it's 2023, 2024, 2019. It doesn't matter to me.
Yeah.
I gave him my 3 stocks. I don't care that the calendar changes.
What I care about is what stocks do I want to own when they hit the price that I want to own them at. That's all that matters. And the more stocks I add to this watch list at certain prices, eventually they're going to hit because a stock can't be overvalued forever.
Yeah.
Look at Tesla. Look at this Tesla thing. Look at Tesla's chart over the last 5 years. It's up a lot, right? Mm-hmm. But it's at the same price it was at.
Did it hit its COVID lows yet?
Let's see here. 831.20. It's almost at the same price it was at on that's almost 2 years and 4 months later. It is even. At some point, people are going to go, wait a second, I'm not making any money. I need to find something else. And when they start dumping the Tesla shares, it'll make the stock fall more and more and more. Stocks can't go up forever. They just can't go up forever. There's got to be a breather at some point. It's like getting sick. You can't have no sickness for your entire life. Eventually something happens. Now, is this timing the market? No. All you're doing is taking a piece of your money instead of your low-cost ETFs that follow the market, a piece of your money saying, I'm going to put this chunk towards stocks I want at prices I want. And as they go lower, I buy them more. I buy more of them. Yeah. And that's why we have our community, because people in here are always talking about great companies at great prices. My 110 stocks, are they all great companies? No. Do I really want to own General Mills? Hey, if it's cheap enough, I do. But mostly there's a list of 20 companies that I have that I want to own really bad. They have great balance sheets. It's just I have to wait for the right price because a great company doesn't make a great stock. Mm-hmm. And that's the big key here. So where are we going in 2023? I have no idea. However, for you, we have a great offer. If you want to join this community to get yourself ready for any sort of market, we have a great offer, no risk offer. You join at everythingmoney.com. If after 30 days you don't like it, email us, no questions asked, you get your money back.
And guys, this goes for the $29 tier or the $79 tier, where if you want to learn about the options, learn about trading, etc. And honestly, 30 minutes a day.
That's it.
I challenge you to join Oracles of EM, pay the $79. If you don't like it after 30 days, that's fine. But do it for 30 minutes a day. You will come out much better and you'll be addicted to it.
I'm a value investor and I still love trading on long-term and short-term charts. I still look at them from value perspective. It's a great way to learn because the more you learn, the less you fear. And that's the big key here. Thanks a lot, guys.